The year is 2027. An American destroyer sits dead in the South China Sea. Not from a missile, not from a cyber attack, from a circuit board that never arrived. Somewhere in the Pentagon, a 3-star general is holding a procurement report that might as well be a death certificate for American naval supremacy. The missing component? A silver-copper alloy worth $37. The consequence? A floating metal coffin worth $2 billion. This isn't fiction. This is the endgame of a resource war that's been fought in silence while economists debated interest rates and politicians argued over debt ceilings. Because while the world has been mesmerized by the theater of gold reserves and Bitcoin halvings, a far more consequential battle has been unfolding in the warehouses, mines, and futures markets of a metal so critical to modern civilization that its absence would send us back to the 19th century within weeks. Silver is the ghost in the machine of modernity. Every smartphone in your pocket contains between half a gram and a full gram of it. Every solar panel converting sunlight to electricity uses 20 grams. Every electric vehicle requires between 25 and 50 grams, depending on the model. Military applications? A single Tomahawk missile uses over 15 kilograms. An Aegis radar system? 500 kilograms. The F-35 fighter jet, America's crown jewel of air power, contains approximately 450 kilograms of silver in its electrical systems and weapons targeting arrays. Now multiply those numbers by the thousands of units needed to maintain military parity with China, and you begin to see the contours of a supply crisis that has no peacetime solution. This metal, trading at roughly $30 per ounce as of late 2024, is simultaneously the most undervalued and most strategically critical commodity on Earth, and China knows it. The mechanics of this silent war are elegant in their simplicity. Silver exists in 2 parallel universes that have nearly identical names but catastrophically different realities. There's the paper market, where banks and hedge funds trade contracts representing millions of ounces that will never be delivered, never be held, never even exist outside of a database entry. Then there's the physical market, where actual metal moves from refineries to factories, from vaults to manufacturing floors, from the ground to the grid. For decades, these 2 markets maintained a kind of uneasy equilibrium. The paper market set the price through the futures exchanges in New York and London. The physical market accepted that price and conducted business accordingly. But something fundamental broke in this arrangement around 2020, and the fracture has been widening ever since. The paper price says silver is worth $30. The physical market is screaming that it's worth far more, but nobody with a microphone is listening. Here's what the industrial reality looks like when you strip away the financial engineering. Global silver mine production peaked at around 900 million ounces per year. Industrial demand, including solar panels, electronics, electric vehicles, 5G infrastructure, and military applications, is now consuming approximately 1 billion ounces annually. That's a structural deficit of 100 million ounces every single year, and it's accelerating. The solar industry alone is projected to require over 200 million ounces by 2025, according to the Silver Institute's most conservative estimates. China controls approximately 70% of global solar panel manufacturing capacity. They're not idiots. Every panel they manufacture for export to Europe and North America removes silver from the global supply pool permanently. The metal doesn't come back. It gets embedded in infrastructure with a 25-year lifespan, effectively removing it from circulation for a generation. This is where the story gets geopolitically uncomfortable. China has been quietly accumulating physical silver for over 15 years, while simultaneously expanding its mining operations across South America, Africa, and Central Asia through Belt and Road infrastructure loans. When a country can't repay a Chinese development loan, Beijing doesn't demand cash. They demand resource extraction rights. Peru, the world's second-largest silver producer, now has significant Chinese ownership in its mining sector. Mexico, the world's largest silver producer, is moving steadily into the BRICS economic orbit after decades of being locked into North American trade agreements. The implications of Mexico's potential BRICS alignment for American industrial security are catastrophic and almost completely unexamined in mainstream economic analysis. If Mexico decides that silver is a strategic resource and begins prioritizing exports to BRICS nations over NAFTA partners, the United States loses access to over 200 million ounces of annual production virtually overnight. The paper market suppression mechanism is a masterclass in financial manipulation that would make Machiavelli weep with admiration. Large banks, acting as authorized participants in silver exchange-traded funds and as market makers in the futures exchanges, have the ability to create unlimited synthetic supply through derivative contracts. When physical demand drives the price upward, these institutions simply write more paper contracts, flooding the market with the promise of future silver delivery. The price gets hammered back down. Miners see lower prices and reduce exploration budgets. New supply doesn't come online. The deficit widens. Rinse and repeat for 2 decades. The evidence for this isn't conspiracy theory, it's documented regulatory history. In 2020, JP Morgan Chase paid nearly $1 billion in fines to the Justice Department and CFTC for spoofing and manipulating precious metals markets over an 8-year period. The fine was a rounding error compared to the profits. The manipulation continued because the structural incentives never changed. Now let's talk about asymmetric warfare in the context of resource nationalism. China doesn't need to fire a shot to cripple American technological and military capacity. They just need to corner the physical silver market, while the Western financial system remains hypnotized by paper prices that have no connection to physical availability. Every ounce of silver that moves from a London vault into Chinese sovereign reserves or into a solar panel manufactured in Guangdong is an ounce that will never be available to the Pentagon when they need to rebuild a destroyer's electrical systems or manufacture the next generation of hypersonic missile guidance systems. This is economic warfare conducted at the molecular level, invisible to traditional analysts who still think conflicts are won with aircraft carriers and nuclear submarines. The modern military runs on electricity, computation, and precision guidance. All of those systems require silver. No silver means no military, regardless of how many trillions you've spent on hardware. The solar sector is the most visible manifestation of this resource trap. Western governments have committed to aggressive decarbonization targets, which in practice means installing hundreds of gigawatts of solar capacity over the next decade. Current solar panel technology requires approximately 20 grams of silver per panel to achieve acceptable efficiency levels. Multiply 20 grams by the billions of panels needed to meet climate commitments, and you're looking at industrial demand that will consume the entire global surplus within 3 to 5 years. Researchers have been promising silver-free solar technology for a decade. It hasn't materialized at scale. The reason is physics, not economics. Silver has the highest electrical conductivity of any metal on Earth. Substitutes exist, but they reduce efficiency by 10 to 15%, which makes the entire economic model of solar energy unviable. You can't just replace silver with copper or aluminum and expect the same performance. The laws of thermodynamics don't negotiate. Here's the nightmare scenario that keeps Pentagon procurement officers awake at night. It's 2026. The United States needs to manufacture 5,000 precision-guided missiles for a potential conflict in the Taiwan Strait. Each missile requires 15 kilograms of silver. That's 75,000 kilograms total, or roughly 2.4 million ounces. The paper market says that quantity is readily available. The physical market says otherwise. Refineries are running at capacity serving the solar and electronics sectors. There's a 6-month waiting list for industrial-grade silver. The price on the physical market has decoupled from the futures price by 40%. The missiles don't get built on schedule. The conflict timeline gets delayed. Strategic deterrence fails. This isn't science fiction. This is what happens when financial markets become disconnected from physical reality for long enough that the illusion becomes the operating assumption of military planners. Let's examine the currency debasement angle because it's the invisible accelerant on this fire. Central banks globally have expanded their balance sheets by over $20 trillion since 2020 through quantitative easing programs that are permanent in everything but name. When you increase the money supply by 40% in 4 years, you don't get 40% inflation immediately because of velocity effects and demand destruction. But you do get inflation in hard assets that can't be printed, that have industrial demand, and that exist in finite quantities. Silver is the perfect storm of all 3 characteristics. It's a monetary metal with a 4,000-year history as currency. It's an industrial metal with irreplaceable applications in modern technology. And global supply is actually declining in real terms as ore grades deteriorate and easy-to-access deposits get exhausted. The last major silver discovery was in 2012. There's been nothing comparable since. The mining industry isn't finding new supply fast enough to replace depletion, much less meet growing demand. The breaking point everyone is pricing for late 2025 or early 2026 comes from the convergence of 3 separate crisis vectors. First, the physical supply deficit becomes impossible to hide when inventories in the London and New York exchanges drop below 3 months of global industrial demand. We're currently at approximately 4 months and declining. Second, a major industrial buyer, likely from the solar or military sector, demands physical delivery of a futures contract position and discovers the metal doesn't exist. The resulting default triggers a cascade of contract failures as the paper market implodes. Third, a geopolitical shock, potentially related to Taiwan or the Middle East, causes a spike in military procurement that exhausts remaining available supply within weeks. Any one of these vectors could trigger the repricing event. All 3 happening simultaneously, which is increasingly likely given current trajectories, would create a disorderly market that makes the 2008 financial crisis look like a minor accounting error. Mexico's potential alignment with BRICS deserves its own analysis because the implications are staggering. Mexico produced over 220 million ounces of silver in 2023, approximately 23% of global mine supply. The United States imports the majority of that production under NAFTA trade provisions that treat Mexican silver as strategically equivalent to domestic production for national security purposes. If Mexico joins BRICS and decides to prioritize exports to China, India, and Russia under a BRICS strategic resources framework, American industrial and military supply chains face an immediate shortage that has no short-term solution. You can't build a silver mine in 18 months. You can't replace Mexican production with domestic output because the United States only produces about 30 million ounces annually from its own mines. The strategic vulnerability is absolute, and China has been cultivating this exact scenario through investment in Mexican mining operations and infrastructure projects for over a decade. The vocabulary of this crisis needs to shift from financial terminology to strategic resource terminology. This isn't about commodity prices or market dynamics. This is about resource nationalism, where nations treat critical minerals as sovereign assets that can be weaponized in great power competition. It's about asymmetric warfare, where a smaller power can neutralize a larger power's military advantage by controlling the resources required to manufacture advanced weapon systems. It's about structural deficits that cannot be resolved through market mechanisms because the shortage is geological and industrial, not financial. And it's about currency debasement, where fiat money systems inevitably destroy their own purchasing power and drive capital into hard assets that have intrinsic value and irreplaceable utility. The paper market's days are numbered not because of some coordinated takedown or regulatory intervention, but because physical reality has a way of asserting itself regardless of how sophisticated your derivative structures might be. You can create infinite paper silver through futures contracts and ETF shares. You cannot create infinite physical silver. The divergence between these two realities has been growing for years, and the gap is now so wide that market participants are beginning to notice. Industrial buyers are paying premiums of $3 to $5 per ounce over the futures price to secure physical delivery. That spread used to be pennies. When the spread reaches $10, which will happen within months at the current trajectory, the futures market loses all credibility as a price discovery mechanism. When industrial buyers stop referencing the paper price entirely and start negotiating bilateral supply contracts with miners at whatever price is necessary to secure allocation, the game is over. China's playbook here is borrowed directly from their rare earth metal strategy. In the 1990s, China identified rare earth elements as strategically critical for advanced manufacturing and military technology. They consolidated domestic production, dumped cheap rare earths on global markets to bankrupt foreign competitors, bought up foreign mining assets at distressed prices, and then gradually restricted exports once they controlled over 90% of global supply. The West woke up around 2010 to discover they had outsourced their entire high-tech manufacturing capability to a geopolitical rival who could turn off the tap at will. The exact same strategy is being executed with silver, but with more sophistication because silver has a paper market overlay that can be manipulated to mask the physical accumulation. Every year that the paper price remains suppressed is another year that China can buy physical metal at below market prices, while Western institutions congratulate themselves for trading paper contracts profitably. The military applications cannot be overstated because silver isn't just a component in weapon systems. It's the foundation of the entire electrical and electronic architecture that makes modern warfare possible. The Aegis combat system, which is the nerve center of American naval operations, uses silver in every electrical contact point because it's the only metal that maintains conductivity in saltwater environments over extended periods. The AN-SPY-1 radar array uses approximately 500 kilograms of silver. Each Arleigh Burke-class destroyer has one of these systems. The United States has 68 of these ships in active service, with more under construction. That's 34,000 kilograms of silver just in the radar systems alone, not counting the electrical systems, the weapons targeting computers, the communications arrays, or any of the other 1,000 electrical components required to make a modern warship functional. If you lose access to silver, you lose the ability to maintain, repair, or build these systems. You can't substitute aluminum or copper because they corrode in salt water. You can't use gold because it's too expensive and too soft. Silver is the only option, which makes it a single point of failure for American naval supremacy. Here's what makes this crisis different from previous commodity shortages. Oil shortages in the 1970s were resolved through exploration and development of new fields. Copper shortages in the 2000s were resolved through expanded mining in Chile and Africa. Silver shortages cannot be resolved through exploration because the easy deposits are gone and the remaining deposits are either in politically unstable regions or require massive capital investment with decade-long development timelines. They cannot be resolved through recycling because silver's industrial applications are dissipative, meaning the metal gets consumed in tiny quantities across millions of products and is economically impossible to recover. A circuit board in a landfill contains 50 cents worth of silver. The cost to extract it is $3. The recycling economics don't work at current prices, and by the time prices rise high enough to make recycling profitable, the shortage will have already caused catastrophic supply chain failures across multiple industries. The philosophical question underlying all of this is what constitutes real wealth in an era of infinite digital money creation. The financial system has spent the last 15 years demonstrating that central banks can create unlimited quantities of currency without immediate hyperinflationary consequences. But they cannot create silver, they cannot create the electrical conductivity that makes solar panels work. They cannot create the antibacterial properties that make medical devices safe. They cannot create the reflectivity that makes mirrors and coatings possible. Silver has intrinsic properties that arise from its atomic structure, and no amount of quantitative easing changes those properties. Financial sovereignty in the 21st century may ultimately depend not on how much currency you can print, but on how much of the physical resources required for industrial civilization you can secure. The timeline to crisis is compressing. In 2020, the silver market was in a deficit of about 40 million ounces. In 2023, that deficit exceeded 150 million ounces. The 2024 numbers, when they're finalized, will likely show a deficit approaching 200 million ounces. The trend is exponential, not linear. The solar build-out is accelerating. The electrification of transportation is accelerating. The militarization of space and expansion of 5G networks both require massive silver inputs. And mine production is flat to declining as ore grades deteriorate globally. The math doesn't work. Something has to give. Either industrial demand gets destroyed through price rationing, which means the collapse of the green energy transition and a slowdown in military procurement, or the price of silver undergoes a repricing event that makes the 1980 Hunt Brothers spike look like a warm-up act. There is no middle ground where everyone gets the silver they need at current prices. China's endgame is elegant in its simplicity. Control the physical metal. Let the West trade paper. When the crisis comes, offer to sell silver to Western manufacturers and militaries at whatever price is necessary to maintain their operations. The price won't be denominated in dollars. It will be denominated in technology transfers, intellectual property, political concessions, and strategic positioning. This is economic statecraft at the highest level. You don't need to invade Taiwan if you can make it economically impossible for the United States to manufacture the weapons systems required to defend Taiwan. You don't need to win a hot war if you can win a cold war of resource denial that makes hot war unwinnable for your opponent. The conclusion isn't about price predictions or investment advice. It's about recognizing that we're living through a fundamental shift in how geopolitical power is exercised. The empires of the 19th century were built on coal and steel. The empires of the 20th century were built on oil and aluminum. The empires of the 21st century will be built on rare earths, lithium, cobalt, and silver. The nations that control these resources will control the technological and military capabilities that define power in the modern world. Yes, the nations that don't will become vassals, regardless of how many aircraft carriers they have or how large their GDP might be on paper. Because in the end, you can't eat GDP. You can't power a 5G network with fiat currency. And you can't shoot down hypersonic missiles with balance sheet entries. You need the actual physical materials that make technology work. And silver sits at the absolute center of that material reality. The war for silver is the war for the future of industrial civilization. And it's being fought right now in silence, while economists debate inflation statistics and politicians argue over debt limits. The question isn't whether you see the crisis coming. The question is whether you understand what financial sovereignty means when the physics of scarcity reasserts itself over the fantasy of infinite paper substitutes. The vaults are being emptied. The supply chains are breaking. The paper market is dying. And the nations holding physical metal will write the rules for whatever comes next. The only question left is which side of that equation you want to be on when the music stops.